you. So thank you guys for stopping in, allowing me to come by for your lunch break here, but I'll jump in. I did get some topics from you guys from office, of course, to go over. Feel free, like I said, so we want a conversation, you see something, ask a question. Maybe you think one of your friends, partners, coworkers may have a question or something you heard of, more than happy to answer it. Again, this is general taxes as well as financial planning, always with disclosures, right? Everyone's situation is different, so we always say it depends. But any investment, any taxes, there's always a risk involved with that. So I was going to start off there. I am a certified financial planner as well as having my EA and enrolled agent designation with the IRS. So I do come from a financial planning background. Myself, I was telling you guys earlier, I grew up in Birmingham, Pennsylvania. Soon to the University of Delaware for a little bit, played football there, in Shell, 3 years at Westchester. Jumped right into the financial planning world, and then as I go along my path here, taxes come up a bunch, that goes hand in hand. So I'll touch on both there, but mostly taxes with this, and then we do clear through Terra, which is our broker dealer, before that, NG. Some advisors, so you get me right that. Kind of get into the meat and potatoes of it, right? So you guys are 1099 employees, NEC typically. So you're running your own business. They may or may not be like that day to day, but you want to know the day you are. So number one is record keeping from the standpoint of income, which is great, right? You want to get as much income as possible, but you don't want to pay taxes. So if you do not keep business write-off or receipts, track of those, you won't have anything. Some of the typical ones are, again, your home office. That is often missed. You can do it a simplified version, which is based on square footage, or some of your clients may have questions about that. When they're buying a house, right? It's a simplified method, or you can do an actual method, which is based off of price of the house, right? And or depreciation and payment. So just understand there's a difference there, it's often missed, but again, basic stuff with all the supplies, marketing expenses, you guys may have out of pocket. See, they may have marketing expenses that they charge you as well, and that's still an expense. So keep track of that. Internet and phone bills is missed a decent amount, right? Even if you're working from home, times get hotspot, right? And your card is a portion of that bill. So 100% of it, and you see people try to percent of it. That's an easy way, when if you ever do one, they say, "Oh, I'm going to," well, it's business. You have to get a portion of it. It can be mostly, I could just understand it.
And on that, so would you think it's better to have a phone just for business?
Yeah. If you can do that, right, separate for then, yeah. Business then, but if you have personal calls. Just, so, it can pay. And that internet can get hard, right? Home, right? Even if you have an iPad, right? It's a computer expense, right? Is your kid using that iPad, right? Using business or you out with it. You just have to be ordinary necessary. You talk about business expenses, it can't be over the top, ordinary, right? It just has to be right and reasonable.
About home office.
Yes.
So if I also have an office space in the like here,
Yeah.
and I'm paying rent to here, can I also take off the home office? Can you do both?
Yeah, you can. So again, I do the same thing myself. We have all space all over, as well as working at home. You can make both are valid. That's how expensive. Now, one thing to know, I'll just touch on real quick for the home office. Most people I'll tell you to do simple. Right, to be honest with you, it can vary in your situation, but if someone were to do the actual method, right, where they're taking a portion of all the bills, utilities, stuff like that, right, and that you're essentially depreciating a portion of your house. Some of you may know this, right? You get appreciation recap. Like you're going to sell that house, right? So there could be a tax bill due. that people aren't really realizing. We do the simplified method, which is $5 square foot up to this 200 square feet. Right now, it's $5 square foot and there's no depreciation recapture. So if your home office is 150 square feet, 150 times 5, it's the bottom, so we don't math from people, but.
Yeah.
Right. So that's the most simple, but they're getting the same rental, and it's been. With, but it's very simple.
Well-
It's simple, you don't worry about the efficient recapture, keep track. Obviously licensing, continuing education, keep your status, your license active in each state, that's deductible. One thing I see people see kind of mess up a lot of times is the meals and gifts.
Yeah.
Gifts, if you give your client a bottle, right, closing or champagne, technically, per client is $25. Per client is $25 in maximum. Okay, and then meals are not 100% deductible. This may change, right? All this stuff that change, right? Especially this year with tax bills coming due at the end of the year. So we'll refer to pre-TCJA for pre-2017, but it's 50% for the deductible for meals. Right?
So clarification on the gift, if I'm doing way more than 25. But if I have my marketing or my logo on it, then I can do that as advertising.
Yes. Different when you can't use something else. Like one thing, people doing a seminar like this, I didn't lunch today. I get very that full of part of marketing for every house. Use a meal, it's the expense per se, but it is. So there is a differential there, but the focus of it, but you're correct, Rich, what's going on is a little bit different. Now, you got a polo and or a blazer, whatever it is, and with logo on it. You can, let's understand that can be used in different situations, non-business. Okay, so you have to be very clear on what is and what isn't, part of your marketing. So that makes sense.
It does,
Yeah.
and just one last thing on the client, so if it's a husband and wife, is that times 2?
Yes. Person, right? There with you. And then obviously,
I have a question. You mentioned that it's a change and the tax is due at the end of the year.
Yeah.
Well,
so, 2017, right, the PJ, job act is status. And you're not doing anything by December 3. They are negotiating that right now, so say a deal. Well, what the taxes will look like June, July, end of June, end of June. Okay, they have a preliminary bill right now, they're not laying things out. We need to be technical how they're doing it, but essentially they have to match. To the state along, but then we're assuming it's gonna look the same. Just understand, right? 2017 opening office. They came out about this one. It does that. So I will say, for a lot of you guys, yes, of course, right? Maybe nice, maybe not, right? Doesn't depend on, all the jobs, right? Well, bonus appreciation is now down to 40%. 100%, right? That taking back meals, entertainment expenses. Entertainment is different than meals. Entertainment expenses are non-deductible. They were. These small little things can change. We still keep track of them next year. We should have more.
I have a question for you. So if you're purchasing like a home warranty for one of your clients,
Yeah.
can that go under business expense
That's a tough one.
or
I would
area?
say-
Yeah.
We say yes, because right here, we're gonna get. Like say if you gave a portion of your back, 10%. Expense for the people, but again, that's written down. You just. They do it and. Do that, right, we get the deal. Yeah. So again, mileage is key. Personally, I drive a decent amount, and I keep track of this from Excel spreadsheet, right? And I have a calendar, right? So today I know I drove from home office to here. And then back. And so just keeping track of that is key. And so understand it's for this year, 2025, it is 70 cents per month. Right, that you get. There's two ways, just like a home office, there's two ways to get a deduction for travel for your home office. It's the same way with travel here, right? So there's the mileage method or the actual expense method. Right? Mileage is simple, just like the simplified version for home office. It's 70 cents. You keep track of those miles of business, and at the end of the year, you add it up, right? And it goes on your schedule C as a car expense. Right? If you're gonna do the actual method, right, you have to keep track of oil changes, insurance, right, car payments, right? What's the interest on the car payments, right? All those things matter, and you have to clarify, right, if you keep track of personal miles or estimate personal miles. To say, okay, this car was used 70% of the time with business, 30% with personal. If you just want to use a simplified method, you're essentially doing that, right? But you're just only tracking business.
Can you write off gas?
So if you're doing the actual method, yes. If you're doing the simplified method, it's all wrapped in there. So there, inside of that 70 cents, the technical breakdown, I don't have it here, but there is, and that's say 2025, excuse me. But it's 2025, 70 cents, but there is a portion that's depreciation for the wear and tear of your car, get your principal back, right? Then investment in the car, and there's a portion for gas, insurance. So it's wrapped all into one. I would tell you if you're unsure, and I'll get to why that is, but if you're unsure, you keep track of both. Right? Now, just know if you you talk about people appreciating cars all the time. There's good and bad with that. Just know if you use the actual method, which means you're depreciating the car plus actual costs you incur, like gas, insurance, right? You can't switch to mileage method. Right? But it's not the opposite way around. Right? You can do the mileage method and then go back to the depreciation. Right, the actual expense method. Right, so just know that. I don't think if people say, yeah, I'm gonna write it all off and I get the mileage. Doesn't work that way, right? It's a write-off, right? It's the depreciation method. Yeah, you may have actual expenses to that, but what's the value of the car, right? And if you only get some of the bonus depreciation, that's going down 20% every single year, so it's zero. What's it really worth for you to take a big depreciation up front and get small little bits at the end, rather than do it based off your. So you can use different trackers like MileIQ, Trip Log, QuickBooks has it. I personally like QuickBooks. It just really depends on how you work your business. Maybe you're not on the fuel always, right? But I would highly suggest to keep track. That can be a big expense.
If I use the miles method, can I deduct also the easy pass or is included?
So that's separate. Polls are separate.
Also separate.
Polls are separate. Now, we can't deduct parking tickets. That is punitive in nature. You can't, can't rack them up. But tolls, yes.
Those
Separate.
pay for a parking, yes,
Yes, tolls and parking, your schedule C, if you look at your tax, for your tolls and parking are completely separate. And even the interest of your loan is completely separate. It's stuff that's- Any questions?
total parking and income.
They're all separate. Just understand the actual, okay, I paid $40,000 for this. Am I gonna use the mileage or am I gonna use the depreciation actual method? Well, you can decide that at the end of the year. So why not keep track of it throughout the year? And we can kind of work your tax bill out. That's one variable you can control.
Now you said the interest is separate.
Yeah.
But if you use the mileage version, you can't take off your interest.
You can.
You can.
Portion, so you just understand, right? If you say that I use my car 50% for business, 50% for personal, right? That interest, then look. Still, that's a business expense.
You can add that to the mileage method?
Yes.
Oh, I didn't know that. Yes.
So the town will not ask you for a car loan, right? The interest in that.
So I think you mentioned something about an oil change or something. I can use that with the mileage method as well.
Okay. No, oh, okay,
That is not.
okay.
Just think actual expenses, maybe it's 5,000. Where some of the other stuff, right, and you usually are 80%. 58% of that. Now, if your car is low maintenance, if you do your own oil change. Let me tell you to go.
Yeah,
Hey, well, maybe you buy an SUV and there's different rules for that, right? You know, you buy your car this year, well, that, you have a big year. Okay, so there's a lot of different variables. Say you try to both, but once you do one, you're kind of stuck with it.
the next year you can't do something different.
You can if you do the mileage, right? Let's understand. The reason you do the actual method and take depreciation is really for a bigger rental. In that year. Okay, you can spread it out over 5 years. That's a useful life for any. And you can spread it out evenly over 5 years, but people will write off, take a big lump sum in the beginning, then the other 4 years will be lower. If you just want to kind of level and even based off of how much usage where and tear actually is. But there's different reasons why you'll do each. Now, just understand, you write off the full value of the car, you turn around and sell it. You know, same like I said, you pay too much depreciation, and you get basis back.
Yeah.
Right, you're gonna pay some time.
So can you keep a mileage log in your car if you do it by hand? I know it's super old school.
Yeah.
Okay,
Better,
yeah,
there, I don't know if they ever seen that, well, as often I could say. I do it based off of. We're on the computer, I got a meeting, right? And just, and this day I was here, this. Percent.
old school, and I think like a teeny tiny little bit, but I mean,
Listen, you're making enough work for yourself.
yeah.
We'll do it a year and a quarter, a week, if you do it as you go.
But the apps are so much easier to keep up with.
Yeah.
I've used my IQ for a long time.
Yeah.
It's so easy.
Yeah, typically you can load them and integrate that into.
Now you move your car, that pops up in the business or.
So that, yeah.
So coming to the actual office, can I use that as my? Okay.
Office, field visit, or your home office, your field visit.
I need to do a showing first before. the office.
If you have an appointment at the office, is that like the other buyer consultation?
Yeah, right. That's your principal place of business. It's really meant for visiting some showings.
Yeah.
Stuff like that. If you're like, for example, you're already writing off the expense of the office.
Yeah.
The mileage, it's just. Yeah. So. Yeah. So again, this goes back into the integration. This is kind of simple, right? What I will say that is account rate, we'll get into LLC that were very topic. Because it does it, the bank does it. But I would keep everything in a separate account. I'm getting paid in a separate, even if you're joining LLC and what she'll need. And then pay your own self. Just good money management. And keep a separate business credit. It could be a business credit under your social, your LLC or. Right, but just understand, everything separate. Different law, one statement. One back, or, they give you one, they do.
So you can just print out the statements instead of receipts if you just put everything.
Yeah, well, for example, I'm currently credit card. Well, right, it's consolidated, print out my credit cards, and I'm keeping track as the year goes on. Right? This date and this expense, there's no missing. So you do it as you go, but print off the credit card receipts, or statements, or get them mailed to you, and go through them at the end of the year, and then keep them. It's a big risk, but you can also do it. It's well, IP paper.
Take 2 days at the end of the
Takes a
year.
while. One thing I will say is just, like I said, it simplifies the tax filing bookkeeping. You can hire a bookkeeper for you. I personally don't do that. It's a service, but there are people out there. But yeah, building business credit, in general, you should have regular credit, good. And so just understand managing that is gonna help, right? doing things, I personally am a fan of credit card as long as you pay them off. You do not trust yourself for paying them. Percent interest is 30%, 35%, whatever they're offering you, it is not meant to hold a balance.
Can you write that interest off?
Fortunately, you cannot, that is personal interest. Right, that's now, if you got a business loan, consolidate that over, and yeah. You could. Okay, but credit cards are personal in nature. From the get-go, you cannot write that off.
But if they charge a monthly fee,
A monthly fee for the credit card, yeah, an annual fee for the credit card, yeah, if it's a business card, yeah. And again, I personally, for me, right, I like the larger banks, right, they integrate well with Chase, Wells Fargo, right? I'm not recommending them and paid by them, right, but they integrate well into others. If you're a small credit union, they're probably the more time. Right? Personally, I would only use and this credit unions are meant to facilitate loans. Big banks, right, they're not gonna give you the highest interest, but they're good for safety and then the ease of use. But also too, kind of jumping into the next thing, when it really comes to managing your debt cash flow and these quarterly tax payments, I think people get caught up with this all the time. You're getting paid as a 1099 employee or not, essentially you're on your own, right, running your own business, so just understand, you do owe quarterly taxes. And they're not every 3 months, like it should be, but it's April 15th, right, which tax act lines up with the tax deadline, June 15th, right, which is 2 months later, September, and then January. So, it's not even, but you need to plan for this, right? It'd be a big outflow in April, because if you owe, right, your normal payment, plus a quarterly amount if you want. Right, this is where we see a lot of people get in trouble, and then they're behind for the year. Right, so a good rule of thumb is anywhere from 25 to 30%. What you get paid, automatically shift that into a separate savings account or money market fund, whatever it is, right? Now, is the tax rate actually 25, 30%? No, not necessarily. Okay, we call that your effective tax rate. You can figure that out in your tax return, what you technically should be withholding from every payment you get. But with you guys, it's lumpy, right? It's a little bit different. But as a safeguard, we typically say 25 to 30%. Now just understand the 10, and we do this, you can do it automatically in your tax return. Typically, if you ask your accountant, where prepares your taxes, we do it to get an estimate. Right? Don't run your previous year amount that you made and make a safe harbor, which I'll get to at the bottom here, estimate for you of what you should be paying in. Now, if you're running above pace for the year, you should probably be paying a little more, so there's no surprise in the year. If you're running below, technically you can lower that amount that you're paying because you're not on pace with what you did in the previous year. But if you're worried about penalties and interest, right, then you want to follow your safe harbor. I'll get to in a second. But just understand, you're your own employee, right? You are employed by yourself. We're paying to outside of Social Security Medicare. And it's 15.3% automatically. If you're a W-2 employee, you're only paying half of that. Right, so people, it's a different ball game, right? And I can tell you this right now, self-employment tax or Social Security Medicare, the government will not forget about that. It will come after you for that if you do not pay that portion. Okay, it's all wrapped into one payment, but just understand, the type of penalties on that are much higher than normal penalties for just not paying or paying late, right? And we're filing late. Understand if you're still shoring things up, at least file an extension. We always tell people. But again, you can add that up, right? 15.3%, lowest tax bracket, married or single, doesn't matter. The width is different for the tax bracket, but it's 10%. Get 25% right there. Right, and then it goes 12, 22, 24, right? Just understand as you go, you should be withholding more. Ownership write-offs, right? You have deductions, you have standard deduction, right? Or itemized if you do that. And then as well credits if you have kids and stuff like that, right? So that's gonna lower that, but as a safe harbor, safe amount, 25, 30%. And this actual safe harbor from the IRS rules here, right? Depending on your income for the year, the previous year, I should say, right? If you made less than $150,000, right? 90% of the tax you owe for the current year, or 100% of the tax for the previous year is your safe harbor. Right, what that means is if you paid tax of $10,000 last year, right, you have to at least need to pay that amount, right, and not owe any penalties and interest. Kind of think of it that way, take the second portion of it, 100% of the tax from the previous year, or 90% of what you owe for the current year, whichever is lowest. Right, so I always tell my clients, it's gonna be 100%, if you're under that 150, it's 100% of the previous year. Okay, just know it's a quarterly installments, right, that's the best way to go about it. If you're over the 150, right? If you're over the 150, so lower up 90% of the current year, 110% of the previous year. Pretty much what that means, if you make over 150, you gotta add 10% onto what you paid last year as a safe harbor. Right, it's pretty straightforward, I know it's either or question there, but just pretty much pay what you paid last year, a little bit more, and you won't owe any penalties and interest, you may still owe money. Right, but you will not owe penalties and interest. Right? Any questions on that? Do you have to pay your taxes? That, unfortunately, well, what you owe, right, of what you owe, so the goal is to get that down.
Yeah.
Obviously, I'm not gonna dive all the way into this,
Okay.
right, but, right, you can be a sole proprietor, which is all of you, at the base sense, right, as soon as you sign up, you get a commission check, you're a sole proprietor, you do nothing else. You're running the business completely by yourself, there's no entity around you. Right, now you can still be a single member LLC, right? And it doesn't change anything. You can just mark it as that LLC or have an EIN number, right? Entity number attached to that LLC, but it still goes back to your social. Everything flows through to you, right? So just understand it is simple, right? It's easy to set up, and everything goes on to your personal return, which is your Schedule C, right? Nothing changes, right? Now, if you're an S corp, and this, just understand, right, there's cost to this, there's strategy to this, and it's not right for everyone, right? Or even if you're above the threshold, right, that I'm gonna say for income, it may not be right, may not be worth it. In some industries, like for myself, right, you're attaching a license to a person, the entity cannot get paid. Right, so just understand, you guys can do it, but there's there's pluses and minuses to this, depending on how you're gonna plan about it, right? So just understand it's different, right? I'll start off with number one, if you file an S corp election, which you have to formally do, right? So you have an LLC, you have to file an S corp election, right? But then you'll do an 1120 S return, right? That's a tax return for the S corp, and then you have to still do your own personal tax return, right? But since you're an employee of that corporation, that's a separate entity, right? You're gonna issue yourself a W-2, right? Plus a profit sharing, K-1, right? The K-1's a profit sharing portion, if there's any money left over, right? But just understand, you're still on the hook as the employee employer for that W-2, Social Security Medicare tax, right? It doesn't really change anything from that fact. What people get, the big benefit for S corps is that you essentially don't pay Social Security Medicare tax for the profit sharing portion. Okay, so the idea of this is to pay yourself a reasonable salary. The rest doesn't say what that exactly is, there's ways and methodologies to get to that. If you pay your Social Security Medicare on a reasonable salary, then anything above that, okay, is not taxed, like tax. Medicare tax. Potentially 15. And you're doing two tax returns. You have other, or you, essentially, I would tell you to get a bookkeeper, right? Because then when you payroll. W-2. So you just understand, not always better. What I would say is the key thing is reasonable salary, reasonable compensation. It could be anywhere from, depending on where you're starting at, your experience, 1,000, give you 120K. Right, just understand you stop paying Social Security Medicare security tax, certain threshold, 1,000. Okay, but you always pay Medicare. It depends on where that reasonable salary would be for you. But the kind of prudent test for that is what would it cost for someone to replace you? You hired someone for yourself, what salary would you pay them? So that's up for debate, but ideally you want to get that as low as possible. Market sharing, and then miss that, that's.
Hmm.
That's really it, right? It's as simple as that, but there are some other caveats. With the S corp, the LLC, so we gotta do work, double taxation there. Um, one thing I will say is, and we, like I said, next slide here, is you get special real estate tax. Right, so just understand business structure doesn't necessarily matter for that, but you can write off other things if there's something that you're. First, how that can fit into your. So you may not need the S corp to essentially get that adoption. Income that other people can get. Then I'll get that. This side here. It's not, but I'll shift back for a second.
In terms of liability protection, which is better, LLC or S corp?
Yeah, I always tell people, if you're negligent, you're negligent. You do something wrong, it's gonna happen to you. And I will say, keeping things separate and having an LLC or a back account for business or not business, we often tell people you not prefer your business. That essentially what we call as doing the corporate veil. Okay, so all that you would have, if you put one personal expense to that business, it is not personal in nature, and if someone comes after you, that's not the grabs. Okay, so you want to, that's another reason, bigger reason why you should keep everything, not just the county standard leads. But if something, say you do that, if something goes wrong, you do something wrong, and you.
Somebody going to sue you for.
Hey, this is America, right? Anyone can sue you for anything.
Exactly.
People, it's not always gonna protect you. Lawyers are good, they can do their job. They make their argument and then the judge. But you can do everything in your opinion while you do. Sure. One thing I will note, and I thought of this, but, look at the status. Because you guys work, there's other reasons why they do these rules, but you guys all qualify for that job, right? What that means is. If you're selling homes, right, your portfolio or your editor, right? And that's all falls in that category. You guys will in real estate to get these special benefits. You may know, if you go really deep into it as an investor, you can do a cost segregation study and get a big write off year one, and maybe it fix a loss. Okay, if you just schedule E, schedule E here, we have personal for your personal portfolio. Right? What real estate professionals has left you do though, is to get a write off. If you have a loss of property, because you are in real estate, you can then offset that with your earning. Right, most people do not really, most people aren't able to do that. Sure, I get a overnight, write off a whole bunch year one. Loss, like a passive activity. Right, real estate is a passive activity, you have your activity in real estate. Okay, so just understand, there are bigger benefits. If you have a good year, years going by, you see a property you like, sell the last race out. Right? Well, what is your cash flow on that property this year? Are you taking a loss there? That can offset earned income. Yeah, most people can do that. You're a W-2 worker, you can't just say, I'm just gonna write off that part. You can't do it. But you're a 1099 employee, and you're a 1099 worker. You're running your own business, right, and you can write off that, if you have a loss, right? Try not to take a loss, but it's different. You gotta know the difference between just buying a bad investment, versus taking appreciating, right? That's a phantom expense. Then on paper loss, that makes sense. No, right, grammar line, there's reasons why you wouldn't do that, you would, but just understand that that isn't. And then this kind of gets to the financial planning aspect of it, the tail end here. And this kind of goes hand in hand, I'll tell you. The most basic thing you guys can do, again, this is gonna, from a capital perspective, it's gonna change for everyone, but have a brokerage or money market fund, right? Act some type of after-tax retirement account. Right, whether you put your extra after-tax payments in there that gets nominal yield in there that's safe to money market, or you're actually investing that money for long term. I know a lot of people in real estate stay in real estate, but it's good to have liquid assets, right? So, just understand, that's my number one consideration, be liquid. Have other investments, but from a write-off perspective, understand you guys have access to a 1099. NECs, right? You have a SEP IRA and a solo 401k. Those are your place you're gonna get the biggest deduction, right? And the numbers, I'm not gonna go too deep in the numbers, it's much more significant deduction than a traditional Roth IRA. It's gonna be variable for all of you guys. I would tell you, if you have a bunch of extra cash left over, the solo 401k is gonna be your best bet. If you have a whole bunch, talk about that, but if you have a really good year. If you have multiple good years, you can even do your pension plan. And you can defer off a whole bunch of annual inside the years. Also do Roth, right, which is after tax, tax free, right on the road. So just understand your after tax goals, have your tax, your bank account, right, for your tax payments, you'll all have retirement. So eventually, you're not gonna work. Okay, no one works forever, no one lives forever. But again, you can also use it for 529s, you have kids, brokerage accounts, like I said, IRAs, just have a plan, right? Put a comprehensive plan together, so okay, this money is going here. Like you had mentioned, right, some insurances, right? So, insurance, we'll provide that for you. You can also get something policy. We'll still, you can get a policy as well, right? So for liability, right, but you need to have certain auto, home, right, coverage to get an umbrella policy, which is an additional extra policy that you already have.
Covered right off my umbrella policy too?
Portion of it. Portion of it's for your business,
Just people.
right? But you have to increase your other coverage. to
Yeah,
get that
yeah.
umbrella policy. But again, long term, other insurance, disability, obviously, permanent insurance, right, long-term care, right? These are all areas you should think, okay, once I have everything set up, how can I protect myself, whether it's personally, right, for my retirement plan and or business wise. Just think about that protection, you want to start there typically, but if you're in the midst of it in the middle of the year, right, get going, get a plan together and then. And then obviously make copies of everything. Yeah, that's something I said earlier, but you can always upload it into Google Doc, Google Drive, right? You can keep paper copies there. Obviously, taxes in general, right? We're in a low tax bracket right now, right? Top marginal rates, 37 or 39% right now. Historically very low. Right? You can see back in the 1940s, 50s, top bracket was 90%. I don't know about you, but I wouldn't want to be paying that. And obviously there's a reason for that, right? Because if it's 90%, I want it to work. Once I hit that threshold, why would I work? Just sit there for the rest of the year, basically restarts, right? So I don't think it's going back to that level, but deficits, right, have to be shored up. Budgets have to be passed. So just understand, if you're thinking you have pre-tax assets, you have a traditional IRA, old 401k, maybe it is good to convert it before the tax law changes this year, right? Think about that. The tax law harvesting, these are little, more advanced topics, but if you have losses in your brokerage account, maybe with stocks or after tax account, you can sell it off, to offset some of the gains and or a little bit, $3,000 of your ordinary income, right? But it helps, right? Okay. Obviously, if you're charitable inclined, gifting strategies, it can be a property to a charity, right? They sell it, they can be tax, pay on that profit. To just think about that long term, again, that can save you a lot. If you actually utilize it. One thing I will say, so it's not necessarily for you guys, maybe your clients, to get the sale done, and kind of make it easy and a service. Obviously, people are moving, one of the biggest assets is their property. It's typically listed in their living room. Right? You can use services like we have wealth. Actually do everything online. So think about what other services can I add to this, help them, right, or get that sale done. Right after they buy that, they can get it. So just understand, you can, attorneys, it could be 2,000, right? Typically for us, we'll be to our norm, but with wealth, they outsource it for, right? But they have to go through an. Just understand, maybe you want to cover that for, maybe that's a sticking point, how does this work? They have words that can do that. So I would highly suggest looking at the estate side of it. That is a consideration we see with clients that do, that they're worried about. obviously revocable trusts,
So would that be we would be able to deduct 100% giving that as a gift?
well, yeah, you pay for that for them, right? I can tell you right now, I mean, if you pay for it, we're, yeah, also doing business. We wouldn't pay the hourly rate, you know, it depends on the lawyer. But yeah, that's a cost of doing business, it's an add-on, right? It's customer service at the end of the day. I have to do it, but it can be ordinary. Right? And just in general titling, I know for a fact in New Jersey, right, for example, you can do a life estate. Right, you can title the property in life estate, right, Pennsylvania can't do that. Okay, so maybe they do need a will, maybe they do need a revocable trust, right, or irrevocable, depending on the family dynamics, back to maybe trust maybe, right? But just understand titling can be huge, that's something that I think is a soft point on a sale, that's a value add for you guys, but also a tax savings. So again, after tax account, the bank accounts you'll see in the middle, right? Make sure you have a TOD on that, just personally for you guys, right? Transfer like that, right? Skip probate, right? It goes directly to the person you want to get it. TOD is payable on death, is for a bank account, right? Typically, or you may pay TOD on that, but that'll go directly to your whoever you want to have it. And then obviously, federal estate tax, gift tax, most people aren't paying it. I'll tell you this, if someone's worried about the state of gift tax, we'll have a conversation, right? Each person gets like 13 million tax on without any federal or state gift tax. Just understand, once you pass that threshold, right, then you start paying the gift or estate tax. So I always tell people, that's an issue, there's ways around it, and to work on it, but most people are not paying that, but that could change after this year. And it could go back down to 5%. But it does increase with inflation every year. And that doesn't say, I'll tell you this, life insurance is included. Life insurance is included in your estate as an asset. Say, okay, insurance income tax free, yeah, income tax free, state, federal, and Pennsylvania, Delaware, or New Jersey, state inheritance tax. It can be taxed too. So just understand that from the state standpoint, for you, or for your clients, like, I explain that to them. But I would tell you, this is a big value add off of this. And then really, again, these are just different areas that we help out with, but, you know, this is about putting a plan together for you. But not only is it just tax or investment, estate planning, actually, just understand. Five years, put it in there, but these are 4 or 5 areas. But I have these slides here. That information at the end here. I can give you guys a part of brochures, but if you have any questions right now, take extras. Based out of King of Prussia, but we do travel clients. We've done Florida, South Carolina, North Carolina, so. And I will add this at the end. I didn't put that in there. Again, 1031 deals. We're somewhat versed in that. If that's you know, an area you guys are in, think about alternatives, right? I know you need to identify a certain amount of properties, right, or certain value properties. And maybe you're halfway there, or you're under, right, to get that deal done. There are actual 1031 funds. It doesn't have to be the property down the street. And we did one, there's a 1031 fund in Arizona, it was the Amazon warehouse. Okay. Client picked 2 of the properties they're looking at, the 3rd property, right, they got an allocation ahead of time for that fund. So if they didn't get the other 2, they can go ahead and get that Amazon fund, and they can successfully do their 1031 with the QI, qualified engineer, right? So just understand there's alternatives out there. Now, not physical where you can touch it and manage it yourself, so your yield's gonna be a little lower, your returns are a little lower, you're not managing it yourself, right? But that is an option to get the deal done and pass it through. So just think about that, you know, in the future. So, yeah. It was a lot, elaborate a lot,
Oh, good. It was good.
but hopefully you guys enjoyed it. If you have any questions hereafter, personal or get questions now.
I missed the very beginning. I did come in at 1, but, I wanna make sure I understand what services you guys offer, so you don't do the bookkeeping. But,
Very clear, right? And EFP, right? This is here. Yeah, that's what financial. So we do straight up financial. The CFP, the financial advisor, So set up a full pay. Okay. Like, on the other side, I'm maybe a town. But I do not, right? We do.
Okay.
So you could be somebody's financial planner and also be their account.
Yeah, no, because if we go hand in hand, you do tax.
That's usually I was.
Even actually from that. Two separate things. You understand? But this is hand in hand. Because yeah, so you're worried about tax. With a rural agent and that. But yeah, we've now started doing where we do business owners, right? So the full cabling, FIRA, you have to pay before them during April or February, March. So okay, you put 20,000 in, and it's you got some going there before we have. So that's type of plan we do at the end of the year.
Is your email correct there?
The email.
Mm.
Yeah, just
Have a line in the middle?
yeah. Well, excuse me. Just this. J. Yeah. Here. Yeah, sorry. So I again it's just this J. It's yeah. This is a again having.
You said you have brochures.
Yeah, I have it. It's for the financial planning, they have the same information here, that part, but we have one other thing. So, yes, thank you for catching it. Jay, what's your? Yeah, justice like the pledge of allegiance, Dot Smith, that's terrible. Yeah. That is the correct zone. That's correct. We will get an office. Yeah.
So how does the process work if either us or one of our clients want to sit down with you? Is it?
It's different, so I know some guys, or I'll say this for clients, yeah, sometimes it's we need to get this tax return done so they can qualify. Yeah, we can help with that. If it's one thing, like it's one, I mean, we're looking at the diversity of what's out there. And that's kind of like a one-off situation where we're helping it help. With the financial planning aspect of it, where they've never had that, right, it was a sale. Should they buy this? Kind of look at the deal here. Say, does this deal work on paper? You guys have metrics, but we have a. So if you're doing a client, we do onboarding. And sometimes we do a quick. We only want a couple things done. But with the CFP, the certified professional designation, it's more comprehensive. So because I do something over here tax wise, may affect my liability elsewhere, or my investments, right? So then we look at the whole pie, not just a slice of it. We can do one off.
How long have you been with Century?
So when I first joined, right out of school, it was like 2017, 2018. We were changed from ING to Voya, so after 3 years. And Voya is still around, we were BFA, Voya Financial Advisors, it was a Kara bought Voya Financial Advisors asset. So it's still under the same broker dealer, the name changed and moved over, the assets moved over, but Voya is still around for B side, but that this is not my 8th year. Okay, so I got my CFP 3 years in, and then I got inflation. Just so you know, you need a designation to do this. But if a reference, you can go down the street or whatever. So,
Are your financial planners salaried or are they commissioned?
no, we have our own. That's what different, I'm saying, nothing, can't, right from the wirehouse or an W2 employee, there's no. We do, we have our own clients, and we want to leave them to care. They're great, right? We can leave them at, right? We do have a broker dealer that does compliance for us. They check our. But yeah, they're really our clients. I'm not saying I would, right? But if I take a year off, I take a year off. If they're okay with it, they're okay with it. But you know, it's good and ups and downs of that. You're running all the costs.
But your fees are based upon the commissions.
Now, so we have, I'll be honest with you, you have, we're doing, you have both options. Typically, what we do is maybe on a commission, yeah, like the advisory. We're providing financial planning with that. Do we have capability of doing insurance? Absolutely, we do. So kind of come to us and that's all I want. I need income for this, we need selling that. And I'll tell you, I don't really like doing that. Because with the CFP curriculum, you do have to have it in the best interest, right? With that designation that you're paying for, you have a code of ethics. And for me to do one thing, if you're asking about one thing, I'd much rather look at the base of it.
Sounds good.
Touching everything from the, you guys make questions first up here.
You do business with Empower agents already or any of the?
So the way I got introduced to this was, he's in the, well, personal friend, where you have their pay.
Okay.
I do work with other agents.
I know.
With, and obviously, you know, I do real estate and future retirees, right? But all that means that we have, end up getting the retiree, the kid comes in. 30, let's say.
Yeah, look what the connection was.
Yeah. No. We just got lucky
Well, yeah,
to.
yeah.
Thank you.
Yeah.
Thank you.